on a daily looks better because it's already done it, right? We're above here, depth equals distance. My target is 63, 63 and a half on this structure. But this pause here gave me pause in my idea, but it does not give me pause, especially with lease rates in London going up to 8%.
We could see silver, based on this chart pattern, run to about $68, $69 an ounce. It could happen literally within 2 or 3 trading sessions based on this chart pattern. So we could see silver and metals have a big pop this week. So it's pretty exciting when we look at the chart, and using technicals. If we use Fibonacci extension, it gives us a good idea of just this short-term rally and this pullback that we've seen.
Vince Lanci, a top global podcast host and best-selling ghostwriter, highlights that the recent sharp rise in London silver lease rates is far more significant than it may appear at first glance. Historically, sudden spikes in lease rates have almost always been linked to moments when the physical silver market becomes extremely tight, either because actual metal availability drops sharply or because major institutions need to urgently renew metal leases that have already been heavily drawn down. According to Lanci, this is one of the strongest early warnings that real physical stress is building beneath the surface. He further explains that silver's current price action resembles what traders call accumulation beneath a structural ledge. In this phase, the price continues to revisit key support zones but refuses to fall meaningfully lower, even when pressured by broader market volatility. Such behavior implies that strong and persistent buying is taking place quietly in the background. Lanci believes that if the price manages to break above the critical $59.33 level, it could unleash a powerful new round of price discovery, where the market moves quickly to find a higher equilibrium because buyers overwhelm available supply. Adding to this market tension is the shifting geopolitical landscape. Russia's proposal to halt all gold bar exports starting in 2026, combined with China removing metal from SHF circulation and earlier restrictions on Russian scrap exports, signals a broader move among major producing nations to keep their metal supplies within their own borders. If similar policies continue to spread across BRICS and allied Asian economies, the amount of physical bullion accessible to Western markets could shrink dramatically, precisely when global monetary stress, inflation concerns, and sovereign-level metal accumulation are all accelerating. This convergence of factors could set the stage for a highly volatile and transformative period in the precious metals market. If you're finding this analysis helpful, don't forget to like this video, subscribe to my channel, and hit the bell icon so you never miss future updates on gold, silver, and global market trends.
You see this, and then you see the retest, but the retest doesn't hold. And then you see this a third time, and it holds. You know, it's not technically a triple bottom, but you should be long, and it should not hold if it gets to there again. But the point being is that while I believe there is a presence in the market keeping a lid on things just below the highs, there always is. And I think silver is part of that equation now as well. While I think that is going on, I think it is going on for a reason, because someone needs to buy, someone needs to cover. We can all guess who that is. Now, one of the things I did say was, I don't think it's a real silver squeeze yet, and I don't think it is, not until the lease rates spike. Now, I haven't looked at them myself yet, but reportedly, the lease rates popped up to 8% yesterday, which would fit my missing piece of the puzzle. If the London lease rates, that's what matters right now. If the London lease rates spike, then that means they need to lease metal again, or they're looking for metal again, or their leases are up, right? Maybe the ones they got from China are up and need to be renewed, and maybe that metal's not available, at least in the short term. So keep that in mind. Here we are in the trading range. I mean, it's actually pretty simple, right? Silver has become like gold. There's a ledge. It's being bought. By all rights, it should test it again, but it hasn't yet. So either we're in a range for accumulation, or this 8 and 9 is meaningless and we're going up. So you should be, as I am, long, with ideas of getting longer if the market is allowed to go above the high of 59.33. So maybe another spike to $60 is in order. So Russia's escalation of gold supply restrictions may signal the start of a coordinated sovereign squeeze on physical metal heading into 2026. Now, this post that we just sent out examines the escalation of Russia's proposed ban on gold bar exports beginning in 2026 and why it matters for global bullion markets. Taken alongside Moscow's existing scrap export ban and China's withdrawal of gold from SHFE circulation, the warrants, the move points toward a broader effort by producing nations to internalize precious metals flows. Russia has used similar tactics before, most notably in palladium, to tighten supply and reshape market pricing. With additional actions emerging across BRICS and Asia, these policies suggest a developing squeeze on available physical gold. At the same moment, sovereign demand and monetary stress are intensifying.
A major shift is shaking the global financial system, and it's becoming visible through explosive moves in precious metals. Gold isn't just rising, it's building pressure like a fault line ready to break. Silver, long held down, now looks primed for a major breakout. Gold has moved steadily all year, breaking past old resistance levels. Chris Vermeulen of thetechnicaltraders.com notes that its current bull flag pattern suggests another 6% rise before the larger target near $5,175 comes into view. Silver, however, is moving far more aggressively. It recently pushed past $61 to new all-time highs, and its short-term patterns hint at gains nearly 3 times larger than gold's. The difference comes from silver's extreme market conditions, an unprecedented liquidity crunch in London, record-high lease rates hitting 8%, and heavy physical deliveries into CME vaults as traders brace for tariff-driven supply issues. The U.S. government labeling silver as a critical mineral has added even more pressure. All of this is converging with the season when precious metals historically strengthen. As Vermeulen points out, December often gives gold and silver a strong upward push, and this year's setup aligns perfectly with that trend. Let's get back to the video.
We're in the perfect environment for precious metals to go higher. And now you kind of drop down to these shorter term charts, which, if we go back to the daily chart, this is where we can get an idea of where the next critical targets are, because the yearly chart, we've already blown past all that. So we could grab the low from this last bull flag pattern, the high that we've had, and this recent low. And this will give us an idea of where this next run is going to go, which is about 51.75 for gold. If we to see what that is, it's about a 22% move. So there's a lot of potential still for gold to the upside over the next couple of months. We could potentially see money rotate into this space. I think one of the big things that'll be interesting to see play out is if the stock market eventually stalls out and rolls over. And if it does, is the money that's coming out of equities, is that going to pile into precious metals and send them sharply higher? I think it will. It's just a matter of waiting for the stock market to actually roll over and start to sell off, and for that new money to be raised to get put to work somewhere. I know. Well, you and I have been doing these reports for the last couple of years, and we just draw these targets each time, and we just keep hitting them time after time after time. Like it's not rocket science, but it is hard to do it because you get hooked into news and emotions, and you worry about giving back too much gain if it starts to pull back a bit, and then you worry about missing out on a move. It's the emotions and the news really take over. If you could pull that away from the market, get that out of your head, and just follow price patterns, which is what I do, which is what I try to help other people do, it really makes things a lot easier. But the problem is, no matter how much I try and keep people on the straight and narrow, like just follow the price charts. This is what it's saying. This is what it's pointing to. They always have all this, they're inundated with news and other people's, opinions and extreme chart analysis that will scare the hell out of people and make them make decisions. So it's really tough. It's tough to put the blinders on and just be like, just let the next 20% move play out. And if it puts in a topping pattern and starts to break down, we'll be able to identify it and we get out. And you're never going to get out at the top. You're always going to have to give back a good chunk of some profits before you know a new downtrend, like the uptrend has ended and then a new downtrend has started. So if you can always realize that you're probably going to give back potentially 5, 10, 20% of a massive, big multi-year trend like this, that's just part of the game, but you have to let it prove that the trend is over before you get out. Right now, it's about a 10% move. And if we do have this 100% measured move, that's going to be around a 17, 18% move to the upside. So this could be a really nice, explosive move in silver if it can get its momentum going over the next couple of trading sessions. And when we look at, I don't have it for silver, but silver and gold are pretty much the same. When we look at the seasonality chart, as you like to always pull up here, Craig, we're coming into that time of year, like pretty much right now, after the first week and a half or, of the year or of December, we tend to see precious metals want to go higher. And usually gold and silver move up together. And so we're coming into the sweet spot, not only for precious metals, but even for equities to have a final push higher. And so silver is really exciting because percentage wise, it's got a very big move, primed and ready. And as we can see from this last portion of this move, in more or less, it was 5 trading sessions, it kind of made, a very significant move percentage wise. If we look at that move, it was about 24%. So I think there's some excitement just around the corner to end the year on a very strong precious metal note. Gold is a little bit more conservative. It still has a very strong chart pattern. This is a huge run up. It's at a big pause. It is pointing to about $5,200 per ounce when all this unfolds. And right now, if we zoom in on the shorter term chart, we've got a very strong bull flag pattern, just very similar to silver. It's had a nice run up. It's had a pullback, and it's just showing that in the short term, while silver shows about a 17% move, gold shows roughly about a 6 or so percent move. And that's typical. Silver percentage wise moves a lot more when it has a run. So I think gold is a little bit slower moving. I find it's more accurate. I find I can win more trades with gold. And see, there's always a trade-off, right? Either you can knock some out of the park, have some huge gains, but you might not win many trades because they're a little more unpredictable, like silver, or you make lower returns, but you win more trades and it's less volatile. So
taken together, these forces point to a market nearing a critical inflection point. Gold remains the slow, steady anchor of the precious metals sector, but silver's tightening supply, explosive technical setup, and rising investor demand suggest a far more volatile, yet potentially far more lucrative, trajectory. The market is shifting into a phase where moves that once took months can now unfold within days, with chart patterns and geopolitical pressures interacting more intensely than ever. As the year draws to a close, both metals appear poised for renewed strength. Investors are now asking whether the current consolidation zones mark the beginning of a new vertical breakout or simply the calm before an even larger surge. What's clear is that structural stress, seasonal momentum, and shifting market psychology are aligning in a way rarely seen in modern trading history. If these trends continue to build, the question is no longer if gold and silver will push higher, but how fast the next wave of acceleration will hit and whether the market is truly prepared for what comes next. If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.